Hi, everybody, and welcome to our second quarterly investor call of 2024, and thanks for joining us today. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, and then clicking on Quarterly Investor Call. Before we get started today, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation can change at any time and without notice. Furthermore, the presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or our YouTube channel to view this call or any of our previous calls.
Thank you, Carly, and good afternoon, everyone. Thank you for being here. This is our second quarterly call for 2024, and today I'm joined with our Director of Research, Dominick D'Angelo. Good afternoon, Dominick.
Hey, Justin.
Peter is on the road, so Dom and I will be hosting the call today. And as a reminder, and for any new attendees on this caller, we switched these calls to a Q&A format after the positive feedback we received from our investor forum last October. So with that, we have some prepared questions. Thank you to those of you who submitted questions to us in advance of this call. And as a reminder, you can type in your questions into the Q&A feature on the call at any time. I can monitor that list and we'll ask those questions as they come in at the appropriate time. So Dominick, I'll get started today. Start with a tough question and a position that we've owned for quite some time in the portfolio, Graftech. We've owned it for a few years now. Performance has not been great in Graftech for a number of reasons, but I wanted to get your take on the recent announcement that a large shareholder is stepping up with an intention to run for a position on the board of directors. Could you provide us an update on what's going on at Graftech, Dom?
Yeah, thanks, Justin. Yeah, as you said, Graftech has not performed great over the past couple of years, both business and stock-wise. And so it's refreshing to see an individual named Nilesh Undavia. He took about a 5.7% stake in Graftech, and he's now running an activist campaign to get a seat on the board of directors. And so just to get some background on what an activist investor is, it's typically somebody with a relatively large stake in the business, and he is trying to gain a position on the board of directors. And typically management teams do not like these outsiders. In general, they all belong to the same country clubs and hang out together. So when we see somebody that's pushing for change in a business, in a stock that hasn't done well lately, it's certainly something to look at. And so I have spent, the past couple of weeks talking with other investors, Nilesh and the management team, some individuals on the board of Graftech, just to get a sense of, what everybody's thinking, what their views are on the candidates. And so to provide some background on the situation, I'll go back to, early 2022, just on, what's happened at Graftech and what brings us to today. And so in February 2022, the CEO, David Rintoul, he was brought on by Brookfield Asset Management, who was the largest shareholder. They owned 75% of Graftech back in the day. He announced his retirement on July 1st, 2022. They appointed Marcel Kessler as CEO. On November 16th, 2022, as we've talked about before, the Mexican Monterrey facility was shut down by the Mexican authorities, and then in November was restarted. Then in February of 2023, Q4 results and Q1 results, or Q1 guidance, were disappointing, and that was largely on the back of the Monterrey facility shutdown. Then in November, Marcel steps down after a little over a year. And then earlier this year, Nilesh files a 13D with his intentions and ownership stake, 5.7%. And then recently, the company announced Tim Flanagan as the permanent president and CEO. He was previously the interim CEO. And so what what are we recommending from here is the question. And so from Schwab, you would have received a proxy form. Depending on how many accounts you own Graftech in, you would receive an email and a proxy form for each account. And within the form, it'll state a couple different things that you need to vote for. And the primary one is there are 2 board of director seats that are up for election. 2 of them are Deborah Fine and Anthony Tacone. Those are the ones that management is trying to elect to the board. And then the third one is Nilesh, who the management is opposing. And so, the question is, who do we think you should vote for? And honestly, the answer is not that cut and dry. I've talked about it before. I actually think management has done a decent job given all the headwinds that I think are out of their control, whether it's a downturn in the steel industry, the Mexican government shutting down their plant. A lot of things that have happened are out of their control. With that said, looking at the backgrounds of the individuals on the bottom right, Deborah Fine, she ran a hedge fund. She started it, I think, about 20 years ago. Anthony Tacone, he has a background in the steel industry and consulting. And then Nilesh was basically a research analyst and a portfolio manager at Wellington Management. And so there's some overlap between Deborah and Nilesh. And I think Anthony, after talking to management and the board as well, brings a differentiated viewpoint on the steel industry given his background. So we think he should remain on the board. The question is, who do we vote for, Deborah Fine or Nilesh? On the left-hand side, it shows the ownership stake of the executives and the directors of the board. Deborah Fine owns about 91,000 shares and Nilesh owns about 15 million. That is a substantial difference. And given the performance of the stock in the business, it certainly would be nice to have somebody that has significant skin in the game that we know is looking out for the best interests that we have as well. And so our thought is to vote for Anthony Tacone, given his steel industry background, and Nilesh Undavia. The lack of insider ownership and lack of insider buying over the past several years is the main concern that we have. I've spoken to other investors and we all said the same thing. If you think your stock is undervalued, the fact that you're not out in the market today buying it certainly speaks volumes. And the fact that Nilesh is out there buying with his own money, 15 million shares, would make us feel a lot more comfortable that somebody on the board is looking out for our interest. So again, within the proxy form, we think you should vote for Anthony Tacone and Nilesh Undavia. Those are going to be the second and third options on the ballot, and then you would have to withhold your vote for Deborah Fine. Justin?
Thank you, Carly. I was muted. Tom. So thank you for that insightful overview of what's going on with Graftech. You had the chance to talk with Nilesh, and in the near term, do you see anything important that he will be doing differently than what the current board of directors is doing?
Yeah, so that was one of the main pushbacks from the management team, was that his viewpoints are not that much different from what their current strategy is. He followed the metals and mining space, which Graftech is in, for several years at Wellington. And I don't think it's the strategy, but I think it would likely increase the focus of the board in the management team. When we talked, he said that the management team maybe skipped out on some conferences and roadshows that could have attracted new customers. And given the current industry dynamic, that certainly would have been beneficial to get extra sales volumes through the channel. So I don't think it's much of a strategy thing as it is just more of a, hold somebody accountable situation.
Good. And can you just comment for people who are maybe not as familiar with the position in Graftech, just what we see as the value there and what our thesis is and reason for continuing to own the investment?
Yeah, so Graftech is one of the largest producers of graphite electrodes that's used in the manufacturing of steel making. So there's two types of steel making. There's an electric arc furnace, which is where the industry is going. It's a lot cleaner, a lot less carbon intensive. And then there's blast oxygen furnace, which is typically your dirtier coal, smelting, iron ore business. And so over time, as the industry shifts from blast oxygen furnace to electric arc furnaces, the demand for graphite electrodes in Graftech's business is going to increase. We've seen several new U.S. mills, electric arc furnaces come online, and there's more planned announcements to increase capacity over the next several years. And so Graftech is the only vertically integrated player with their raw material, which is called needle coke. That also has a use case for EV batteries. Right now, we kind of have a confluence of a downturn in steel demand plus a downturn in EV sales, and that's why the market's getting hit so heavily. But at some point, EVs are going to continue to rebound, are going to rebound in sales. They're going to be the future of driving, and as that takes hold, there's really no new supply of needle coke coming online, which means the demand and the price for graphite electrodes is going to go higher. Since Graftech is vertically integrated, their costs are going to remain relatively stable. They're going to be able to charge higher prices on the graphite electrodes, and thus that difference is going to be a lot more profit for Graftech in the future. Just the question is, when does that turn? Is that the end of this year, or is it 2025, 2026? When does that happen?
Right. It reminds me of some of our other commodity related investments that we've owned in the portfolio. Thinking particularly of like a Capstone Mining, where we waited for years for the price of copper to turn, but when it finally turned, it turned in a dramatic fashion, and we owned the low cost producer, and we benefited tremendously when the market turned in our favor.
Yeah, I'll just add one thing. Nilesh said something that I almost fell out of my chair. He said that he thinks Graftech could be an $80 stock, and with the stock at like $1.50, that is, again, that's his words, not mine, but he certainly sees a path towards a lot of value creation in the stock. Obviously, you need a lot of things to go right for that to happen, and that seems like an impossibility today. But there certainly are cases where that is in the range of outcomes.
So, well, as you showed on our earlier slide, we've added to this position during this down period, which is typical to our fashion of investing. Is if we have a strong thesis and that thesis hasn't changed and there's not a material change at the business, if the price goes down and we have that conviction, it's time to back up the truck. So we've continued to add to the position, which I commend your efforts. Why don't we switch gears and go into our next question? We recently initiated a position in AerCap and have since added to it. Can you give us an overview of this investment, what our thesis is, and why we believe it's such an attractive company to own today?
Yeah, AerCap is like the most exciting, boring business you can find. Their business model is very simple. They buy aircraft from Boeing and Airbus, and they lease them out to Delta, American, United, your largest airline companies. And so what the basic thesis is Boeing and Airbus have undergone a significant amount of problems over the past couple of years. It all started back in Boeing with the 737 MAX crash. I believe that was in 2019. And since then, they have just been underproducing relative to their 2018 production levels. And so the chart on the left shows how many commercial aircraft are delivered per year versus what they were produced at 2018. You can see 2019, 2020, 2021, 2022, 2023 are all well below 2018 levels. And then the chart on the right shows that basically this is due to Airbus or due to Boeing in the beginning. And then more recently, Airbus has also had some production issues. And I just want to say that the CEO of Airbus, says the supply chain is a world of bottlenecks at the moment, and we have as many situations as we have suppliers. There are just many problems, whether it's on the labor side, whether it's on the component side, that are disrupting the production of new aircrafts. And so AerCap is the largest lessor of airplanes. And if you think about an airline, they have routes that they've already pre-sold, and they likely have expansion opportunities that they're trying to pursue. And if you cannot buy an airplane from Airbus or Boeing because you won't get that plane delivered to you until 2030 or maybe even later, depending on when these production issues get sorted out, the only surefire way to get an airplane, today or within the next couple of years, is to go to a lessor. And so what's going to happen is the lessors know that they are the only source of supply, surefire supply of aircrafts, and they're going to be able to charge higher lease rates to these airlines going forward due to the supply level being lower than demand. We're basically at and exceeding air travel demand compared to COVID levels, but again, the production levels are well below pre-COVID levels. And so what's going to happen moving forward? We expect AerCap to charge higher lease rates going forward. And then in addition, on top of the aircrafts themselves having an issue, there's also a recent issue on the engine side. Pratt & Whitney is one of the largest aircraft engine producers, and they recently had an issue with one of their engines that's going to result in the grounding of many of the engines. And so the chart on the right shows that these Pratt & Whitney engines are mainly powering the A320neo aircraft. And the right chart shows that in 2024, about 350, around 600 to 650 aircraft at the peak are going to be grounded because they're not going to have an engine supporting that aircraft. And so we've got now less production on the aircraft side. We now have existing planes that are supposed to be flying grounded because they don't have an engine. Again, that's all leading to less supply of aircraft. That's going to increase the demand of AerCap's existing fleet. And so they're, again, going to be able to charge higher lease rates going forward. The CEO is Angus Kelly. I've met him several times. He's an unbelievable capital allocator. He's probably in my top 3 favorite CEOs. He is very candid, very straightforward, and he is somebody who has significant skin in the game. I think he owns 3 or 4% of AerCap, and so he's somebody I trust. And this is not really a business I worry about at night, because I think they have a lot of tailwinds at their back. They have a great CEO at the helm, and the tailwinds are unlikely to abate anytime soon.
Great. Dom, why don't you just a shameless plug here on the recent podcast that you were featured on with your analysis of AerCap, and we can direct people to that link if they'd like to check it out further.
Yep. So I went on. It's called Hustle Hub. It's an Italian student runs the site. And if you just go into YouTube, type AerCap stock pitch or AerCap stock analysis, it'll be one of the first ones that shows up. And it's about a 45-minute video. I just go much more in depth on the thesis. Happy to send the link if you can't find it as well.
Great. Thank you. This next question came from one of our attendees and was submitted in advance of the call today. It has to do with Warner Brothers Discovery and really the media industry as a whole. There's been a lot of first fragmentation and now what seems to be consolidation going on. There was this deal between Warner Brothers and Paramount that fell off. Dom, could you comment on our investment in Warner Brothers Discovery, what we see there, and then just a broader overview of what's going on in the media industry?
Yeah, absolutely. It's definitely an interesting question and an interesting industry, to say the least. So, in COVID and prior to COVID, the name of the game was basically get as many eyeballs on the platform as you can. And the way you would do this was by under monetizing the assets that you had. So Netflix maybe historically charged $7, $8, $9 to have an ad-free viewing experience. And now that name of the game is shifting from we want eyeballs to we need to show profits for our shareholders. all of these guys have burned billions of dollars over the past decade trying to build out the platform, build out their content library, and now shareholders are done waiting. We are looking to see profits. And so one of the things we've seen all these platforms do is go from an ad-free, which means you watch a video, you don't have to worry about advertisers, to an ad-supported tier. And so now you might watch a 20-minute video, and along the way, you have to watch 2 to 3 minutes of advertisements. And this will substantially lower the cost of the user experience. So instead of paying $15 to have an ad-free experience, maybe you have a $7 to $8 monthly subscription price, but you have to watch 2 to 3 minutes of ads per every 30 minutes or so. And the way this helps the streaming platforms is Netflix or Paramount, Max will generate revenues from the advertisers. So your advertisers are paying to, again, advertise to the viewers. And so if you can go from a platform that charges $12 to $15 a month to $7 to $8 a month for one with ads, that's going to entice a lot of different viewers that weren't, willing to pay the 12 to 15 that are willing to pay the 7 to 8. It's going to give them the opportunity to get onto the platform. And for the likes of all these streamers, there is really no incremental cost to having one additional subscriber. And actually, if a person chooses to have a ad-supported tier versus an ad-free tier, it's actually more profitable for the streaming platform, for Netflix, for Max, to have that ad-supported tier than it is for them to have the ad-free tier. And so what's going to happen? It's likely going to cause a lot of the users that are on the lower end of the spectrum, think your Peacocks, maybe Hulu, it's going to shift them from those platforms to the Netflix, Disney Plus, Max, because if you can go from paying $4 or $5 for Peacock to paying $7 for Netflix, or $8 or $9 for HBO Max, the content library, in a lot of consumers' opinion, is worth that incremental step up. Maybe they weren't willing to go from a $5 to a $20 ad-free, but they're willing to go from 5 to 10. And so you're going to see a shift from the smaller scale players away from them and towards the larger scale guys. And what this will happen is those small guys, they're going to start to bleed profits. I suspect a lot of them may go away in the end. And you're going to end up seeing Netflix, Amazon, Disney, Warner Brothers. They're going to go in and buy those assets for the content library that they have, just at a much lower price than where they're currently valued today. And so tying this to Warner Brothers, basically what we're going to expect to see is their main goal right now is to deleverage the balance sheet. We're probably going to see pricing increases again throughout the year, again in 2025, because the content cost for all these platforms has gone up so much that they need to find a way to pass this through to the consumer. And so that's going to, again, result in higher prices, or maybe it's going to result in more ads. Instead of watching 2 to 3 minutes of advertisements, you're going to watch 4 to 5. That way they can generate some incremental revenue. And so in a couple of years, what's going to happen? You're probably going to see more M&A in the space. Warner Brothers is going to lower their debt amount. That's their primary focus right now. And a lot of the platforms, Netflix, Max, they primarily focus on, call it the US or North America right now, and are now expanding into Europe, Asia. And so that's one of the things that we see Warner Brothers, and specifically HBO Max, doing right now, is that they plan to expand into Europe. I believe it's in mid-May, and that's going to be a new revenue line or a new revenue stream for them. To say the least, it is a pivotal year for Warner Brothers. They've had a lot of headwinds on the advertising space. This year, they've got the election, they've got the Olympics. This should be a very profitable year for them, which should allow them to deleverage and then get back into, either returning cash to shareholders or going out and making the acquisitions that I talked about earlier.
Good. Can you just talk about our activity as it relates to Warner Brothers and kind of just how we've been handling this one from a portfolio management perspective, Dom?
Yeah, so we made our initial purchase, well, I would say we made our initial purchase several years ago, and then the stock ran up, and then we sold it around 65, I believe, 70, and then the stock collapsed back down to 30, and where we started making our purchases again. we've made a few of those initial purchases. We haven't added to it substantially on the way down. I think we might have made 1 or 2 purchases along the way down, but when the thesis is they need to deleverage the balance sheet, and that has not occurred at the pace that we've expected to, we are more focused on, can the management team, is the right management team in position to execute the strategy until there's a little better of a picture that they are going to be executing on that strategy. We're going to hold out the position size that we initially took is such that if the stock and the business do what we think it can, deleverage and then start growing and producing a lot of free cash flow, we're going to do just fine. The portfolio is in a position where it's not going to kill us if it takes a little longer than expected to play out. On the flip side, if they can really deleverage the balance sheet over the next year or two, we're going to do really well in the stock.
Great, thank you. Next up, we have our largest investment has been Nvidia, which is owned in most of our long-term clients' accounts, actually in all of them. And we had sold some Nvidia last year and have an outstanding option contract that's due in June on the 21st. Dom, we continue to get questions on what's going to happen in June. Can you just walk us through the option contract and what our investors can expect in June?
Yeah, I'll try. It is not the easiest concept to grasp by any means. So just a brief refresher, every option is equivalent to 100 shares of stock. And so on 8/10/2023, we sold the 300 strike Nvidia call option that expires on June 21st, 2024 for $157. What this means is we agreed to sell 100 shares of Nvidia on 6/21 for $300 per share. In doing so, we received $157 per share, which means if you take the 157 times 100, we generated $15,700 of cash on 8/10. We were allowed to do whatever we want. If we wanted to hold it aside and to our money market mutual fund, we could do that. If we wanted to go out and make other purchases, that was also an option as well. And so in your brokerage account, on your online account, if you open it up, it'll say something to the effect of you own Nvidia. It'll then say the name, in equity, the number of shares you own, the price, and what the market value is. In this case, we're going to just say you own 100 shares of Nvidia. The current trading price is $845, which means the market value is roughly $84,586. On the call option side, it's going to show you when it expires, what price we agreed to sell at, and how many contracts you sold. And then the price is the price of that option if you want to buy or sell it today. And so what you'll notice is the current market value of the stock is, call it $84,586. The value of the option is negative, since we sold it, is negative $54,965. And if you take the difference between the two, it's roughly $29,600. Over the next couple months, between now and June 21st, that $29,621 is just going to likely drift upwards to $30,000. And on June 21st, 2024, the difference between the two is going to be exactly $30,000, because if you take $300, the strike price times 100 shares, that's the value of the position. So that brings us to today. So Nvidia trades for $850. Value of 100 shares is $85,000. Roughly speaking, the value of one call option is negative $55,000. And so to put it into context, what happens on a daily basis with your account? For every $1 move in Nvidia stock, the value of 100 shares owned increases by $100, which is standard, right? Any stock, if it increases by $1 and you own 100 shares, it's going to increase by $100. On the flip side, the option is going to, the loss on it is going to increase by $100. So if Nvidia's stock goes from $850 to $851 and you own 100 shares, the value of your position goes from $85,000 to $85,100. So that $100 increase. The value of the call goes from negative, again, because we sold it, negative $55,000 to negative $55,100. you are in the exact same position. If you take the difference between 85,000 and negative 55,000, or 85,100 and negative 55,100, that value is $30,000. And so on 6/21/2024, when the option expires, the question is what's going to happen? Schwab is automatically going to sell 100 shares of Nvidia at $300 per share. Again, there's that $30,000 number for every one contract that you own. The option contract is then going to go away at this time. So your account is going to show a $30,000 increase in cash, 100 fewer shares of Nvidia, and no options contract. If you have any questions on this, please put it in the chat, because we've gotten several. It's not an easy concept, and we've gotten several questions about it.
And I feel a lot of these questions, Dom, and I'll ask the one that everybody wants to know, which is, so on this date, is my account value going to fluctuate tremendously because the option is called?
No, your account, if you look at your account balance at 4 o'clock on 6/21, it is going to be basically the exact same as when you wake up the next morning on 6/22. Or it's going to be, yeah, 6/22, 6/24, whenever the market opens the next day. What you see in your account today is the true reflection of this option contract. Nothing changes other than you lose the shares, the cash increases, and the contract goes away.
And I've reviewed this strategy in many of our meetings for those clients who are on the call who have these options, but I'll say this again. Effectively, we pre-sold Nvidia when we did this a year ago, well, in August of last year. And the idea was, we thought the price was very high then. We needed to take, as a portfolio management tactic, some of the risk of owning one single large holding out of our portfolio. We sold some outright, and then we pushed this option sale into the next year at a significantly higher price than what we could outright sell the stock for at that time. And so the optionality that provided us was, we were going to sell the stock if Nvidia continued to rise and become a larger and larger portion of the portfolio. And if for some reason it didn't and it shrunk back down, we would not be forced to sell these options at a price that we didn't, and we would have profited from selling the option contract in the first place. So
exactly.
Again, happy to field any questions on that. We can move on to the next question, which just talk quickly, Dom, about the cash that we've accumulated in the portfolio as a result of selling Nvidia, and what we've been doing to get this cash invested over a realistic time frame that you have outlined here.
Yeah. So one of the problems when you sell such a large amount of stock in a very short amount of time is, oftentimes there are not many ideas that you can put the cash to work in. So in our case, we took a lot of the cash, we invested in SWVXX, which is the money market mutual fund, earned a decent rate of return. Right now it yields about 5%. That way, it's guaranteed, insured, and as opportunities arose, we would take advantage and use the cash proceeds to invest in. And so on top of this, some clients, obviously, when you sell a position that it basically has a $0 cost basis and could result in substantial taxes, so we had to set aside cash there. Individuals have RMDs and then other cash needs. And again, where appropriate, we would opportunistically add 2 positions. And thus far in 2024, we initiated a position in AerCap. We added to Bank of Ireland, or in some cases, if you did not own it, we initiated a position in it. And then recently we added more to our AerCap position. Going forward, Peter and I have several ideas that we are working on, and the plan is to invest the cash, the cash available to us today, down over time. The next issue, or the next thing that's going to happen, is on 6/21/2024, your cash balance for those that have the option contract is basically going to be replenished from that sale. So again, that $30,000 of cash from the options contract. Again, our goal is to just opportunistically add to positions or initiate new positions when we see fit.
Yeah, and I'll comment on this. It's been a volatile start to the year, and we would have no reason to suspect that volatility will subside. We're going into an election, as Dom had mentioned, and the optionality that cash provides us does two things, really. If we did have a big downturn in the markets, having a substantial part of the portfolio invested in cash, that money's not going to fluctuate down. So it provides us with some downside protection. And the second thing, which is more attractive to us, is it allows us to be buyers in a period where everybody else is selling. And as you know, for those of you who have been with us for a long period of time, we use these periods of disruption in the market to be opportunistic and back up the truck to ideas that we think are very sound businesses that have lots of opportunity, and maybe the uncertainty is high in the current moment, but as that uncertainty clears, the ability to see outsized gains in the portfolio exists, and that is where we want to be positioned whenever we enter that next market downturn.
Great.
We did, if you want to switch to the next, we did get one question that came in from Ed, and please feel free, everybody who's still on the call, to just pop in your questions into the Q&A or chat box. We had a question. It's centered around the artificial intelligence marketplace, and the question is: are there other value stock or company considerations that we are exploring beyond the obvious ones that we own, Nvidia and Qualcomm, given the strength and outlook in this area?
Yeah, I'll say I think about this every day for every company that we own. I think the applicability is going to be so far beyond what you're initially thinking. Whether you specifically mentioned Nvidia and Qualcomm, just simply think about like a grocery market or a grocery store and how much waste in produce that they have on a daily or yearly basis. AI is likely going to make it, such a smarter company in that they're going to now know, say Tuesday and Wednesday, for some reason, pineapples or whatever the fruit is doesn't sell. And they're going to be able to lower the cost or the amount of product that they buy on that day. Or it's going to have to do with scheduling, workers. I think every single company, if they're not using it now, they're going to fall so far behind their competitors that are using it that it's going to become pretty clear who is leveraging this technology and who is not. Specifically on like the tech front, you got companies like Avago, Marvell. Those are companies I've looked at. I think the issue right now is that everybody kind of knows or is looking at these names, and when everybody's looking at those, probably not going to be value. I would say the industrial side is probably going to offer more, more interesting use cases. So if they're not using it now, it's an issue. Every conference call I listen to, every meeting Peter and I have, that's typically like the first question is, how are you leveraging AI to advance your business? And I think a lot of management teams are putting in a practice or putting in a use case to find a way to make their business more efficient.
Yeah, it's absolutely accurate. I mean, we see it in the field of finance. And I will comment on this. I would say it's somewhat noticeable now when artificial intelligence applications are being introduced into these businesses. But the machine learning capacity has really smoothed these experiences out and will continue to do so, such that the applications for artificial intelligence will eventually appear seamless, and you won't know that the business is employing these technologies as they progress.
If you think about a company like Warner Brothers, it might not seem obvious how AI is helpful to them, but if you're Warner Brothers and you have HBO Max and you can target an audience better because you can find the correlations of somebody who watches Stranger Things, I know it's on Netflix, but if you can find, more correlations between users and then target ads to them in a better way, advertisers are going to be more willing to pay a higher amount for that because they know the audience is more likely to buy the product or service that they are advertising to.
Correct. We don't have any other questions in the chat box or the Q&A section right now. But why don't we hang out for just another minute, Dom? That was a pretty comprehensive presentation. We're happy to stick around, and if you have some questions, please pop them into the Q&A or chat box. I don't see any other questions coming in, so want to thank everybody for being on this call today. Dominic and I appreciate your time and attention. Carly, can you just give us some details on when this call will be up, recording will be up on our website and on YouTube?
Yes, so thanks for joining us again today. Our presentation will be up on our website tonight and on YouTube. So you can go to our website to get a replay of that underneath the resources tab. And you will be receiving an email tomorrow with the recording as well. So keep an lookout for that.
Thank you, everybody.
Thank you.